food store. You know, I mean, you never go see a doctor or anything. I mean, so yes, be very cautious there. And contemporaneous record keeping is most desirable. I'm guilty of this myself. I'll incur an expense, let's say on Monday, and I'll say, well, I'll do it on the weekend. And then I forget the specifics because I didn't do it right then. Okay, well, come up with more questions for depreciation. Now we're going to introduce a new topic, a new area that again we'll spend time with next week. Capital assets. There used to be a multiple choice question on the final, which, and I think this was in the undergraduate class, but the gist was capital assets are not defined in the Internal Revenue Code. What is defined are what are not capital assets. In the old days when we had less material, 10-week terms, we used, and 30 or more students in each class, we used to go around the room. And I'd say, everyone give me an example of a capital asset. If you were the 30th person, it was hard to come up with something. One year someone said, my baseball glove. Someone said, well, my baseball bat, because I'm not a professional ball player. Two categories. The first one, personal use assets. Your house, that's not a business. Your car, that's strictly for personal. If you sell it at a gain, capital gain. Sell at a loss. This was on the exam today, wasn't it? Loss on the sale of a personal residence. Letter H, not deductible at any time. It's the one-edged sword, cuts always the IRS way. Secondly, investment assets, stocks, bonds, paintings, my baseball card collection my parents threw out when I was in college. Sell at a gain, capital gain. Sell at a loss, capital loss. Not capital assets. I know we had Vernesia in the other class said, I know a capital asset, a machine used in my business. Not a capital asset. Not capital assets. Number one's no surprise, inventory. You sell inventory, that's ordinary income. You know, you're, well, one of the students, remember, Deja, who was here, works for Walmart. They sell Walmart merchandise, that's ordinary income. That's their major. They're a retailer selling inventory. Accounts and notes receivable from the ordinary course of business, because that's related to the sale of inventory. Ooh, look at number 3. Artistic works received from the hands of the creator. Let's say that Pablo Picasso was still alive and he and I are drinking buddies. So we're at the local tavern and we're hoisting some brews, and I tell him that, guess what, today's my birthday. So he takes a cocktail napkin and he does an etching on there and signs it, and of course I immediately put it on eBay. Not a capital asset, because I got it from Pablo, the artiste. Let's say my grandmother bought me an etching from Merrill Chase Gallery and gave it to me and I sold it on eBay. That's a capital asset because grandma was not the creator of this particular etching. In blue, to emphasize this, personal, now remember the term personal now means non-realty. Used in the trade or business is not a capital asset. As we'll see next week, however, which why taxes are so damn confusing, it may get long-term capital gain treatment via what some of you are researching, the 1231 netting rules. But trucks, machines, furniture and fixtures, computers used in the trade or business are not capital assets. They're going to go over here. And realty used in the real estate used in the trade or business, like the building where your factory is located, not a capital asset. Let's come over here. Yes, go ahead. Mary.
On the artistic works, that's specifically just art received from the creator.
Well, as we'll see next week, there's a promise that if you received, let's say you received a letter directly from Bill Clinton, those things are worth money, when you get them from, famous people. That's considered something artistic because it comes from a public celebrity type thing. So we'll see. It's a little bit broader than you might imagine.
But if you go out and purchase $100,000 painting, is that considered a capital asset?
That's a capital asset, yes. Now, what if you went to an artist and paid him let's say Andy Warhol, remember Andy Warhol and the Campbell soup can, and you paid Andy $100,000 for, one of his works, then it's not a capital asset because you got it from the artist. Think about, though, that Barry's got some good ideas there, and I'm going to have a little humor next week on one of them relating to a letter, but we'll talk more about that then. I haven't asked you to learn a lot of code sections, but there's some that you have to know because that's the way the items are identified. Section 1231, assets. Personal and real property used in the trade or business and held for, what's the timing here? 1 year on 1 year. Now this we'll see more next week. These are not capital assets, but they might get long-term capital gain treatment. That's why that has to be greater than 1 year. So it would qualify as long-term. In the 1997 Tax Act, the holding period for long-term was changed to 18 months or more, a year and a half. So that would have said, and must be held greater than 18 months. That changes based on what the holding period is for long-term, even though these are not capital assets. Isn't that confusing? We'll hopefully explain that more next week. That's why I love taxes. Now this is like a big umbrella, 1231. 3 items under the umbrella. Section 1245, depreciable tangible personal property, some amortizable intangible also falls under that. Machines, vehicles, furniture, and fixtures used in the trade or business. In purple, section 1250, depreciable real property, buildings and improved parking lots. That means they're paved, asphalt, concrete. Other 1231, these are all 1231 assets, but these are subdivisions of 1231. Land, unimproved parking lots, gravel, dirt. Now let's look at this. So Lena doesn't have to move the camera, I'll slide over here. I have a truck used in the business for 9 months and then it's sold. Well, I was going to stand, but this is easier. Normally a truck used in the trade or business would be what classification of asset? Truck used in the trade or business. 1245, wouldn't it? Subdivision 1231, 1245. What's the problem here? Wasn't held long enough. Now, I have my own name for this type of asset, but don't use this with the IRS. It's Bill's name. I call these limbo assets because they're kind of in limbo between two worlds. They should be 1231 assets, one of the subdivisions, but they weren't held long enough. So if you have one of these, and we'll see these next week when we look at some, I have some old supplemental problems from the 90s, but they're great. You'll love them. You're going to have ordinary income or ordinary loss. Ordinary income or ordinary loss. These are assets that would be 1231, but they don't meet the holding period requirements. So they're in limbo between two worlds. But that's maybe I ought to put it in brackets here, or quotations. Bill's term, limbo assets. That is not an official acceptable term, but they're between two worlds, kind of like they're in purgatory, not belonging to either world. And we'll see more about that next week. Now our final area, the capital gain and loss netting rules. First of all, a question for the class. On which schedule, I want a letter, which schedule are capital gain and loss transactions always reported? Which schedule? No, that sounds like the partnership K1. It's always Schedule D. But there's a special Schedule D for each type of taxpayer. So an individual like ourselves, 1040 Schedule D. And there's another support form that has the detail. Corporation, 1120 Schedule D. Trust or estate, a fiduciary, 1041 Schedule D. Whereas when we talk about these 1231 assets, that's a unisex form. It's the 4797. Someone mentioned that earlier in the term. The 4797 is used by all taxpayers, but Schedule D is specialized for the type of taxpayer. Now, we're going to look at corporations and individuals. Individuals here are going to be in blue, corporations in black. If you have long-term capital gain and long-term capital loss, I think I need to stand. Lena, I need to stand for this. You net the long-term gain and the long-term loss. Let's say we end up with long-term loss. You had short-term capital gain, short-term capital loss. You netted those, you had short-term capital gain. So you net the long-term loss with the short-term gain, you end up with short-term capital gain. Short-term capital gain for individuals in blue, corporations in black, ordinary income. Always ordinary income. Let's do it again. I have long-term capital gain, long-term capital loss. I net them, get long-term capital gain. I have short-term capital gain, short-term capital loss. I net them, get short-term capital loss. I net the long-term gain and the short-term loss. I get long-term capital gain. For individuals, taxed in either 15% or 20%. The 20% is more for upper middle income or wealthier taxpayers. Most of us in here are probably in the 15%, but maybe someone in here is wealthier. Someone might want to research this. Through the end of 1986, corporations had a preferential tax rate on long-term capital gain. It was called the alternative tax on long-term capital gain, and it was 28% at a time when corporations were paying tax at 46% and even 52%. How things have changed. Tax is ordinary income. Let's do it again. Long-term capital gain, long-term capital loss, net them, and we have long-term capital loss. Short-term capital gain, short-term capital loss, I net the, I have both long-term capital loss and short-term capital loss. Most unfortunate. For individuals, by the way, you want complexity? This is between 1970 and 1986. There were differences in the tax treatment of these. That led even more complexity. Thank God we don't have that now. Individuals, if you have $1 million either short or long-term capital loss, you could use it to offset $1 million of capital gain. But what if you end up with just capital loss? Individuals have a capital loss deduction equal to the lesser of the short-term capital loss plus the long-term capital loss, or $3,000. It's been $3,000 since I think 1978. It was $1,500, and there was legislation in committee to make that $10,000 when the recession started, but it never got out of committee. But there's an unlimited carryover. Corporations. Corporations don't have a capital loss deduction. Why do corporations want to have capital gains, especially long-term capital gain? Because that's the only way that they can use their capital losses. Capital losses can only be used to offset capital gains. Corporation can carry back 3 years. I know this form well. Form 1139. When I worked for CBI Industries, we had a lot of capital loss carrybacks. I always volunteered at that time. Now they have to file electronically. This is the 80s, guys. So I always volunteered because it was on my way home, because I lived in Lincoln Park and worked at Oak Brook. I would volunteer to stop by the IRS offices and personally deliver the tax return and get a stamped receipt. I would file the consolidated tax return, and then after I filed that, I filed the 1139, where we carry back capital losses that we have. Or you can carry forward 5 years only, 5 years. What if you can't use it within 5 years? You'll lose it. So a lot of planning there. You want to get the benefit. If you suffer a capital loss, you want to get the benefit of using it. Individuals, it's unlimited carryover, so it's not as much of a deal. But it could be. I had a client once at Arthur Anderson, had $1 million, this is back in the late 70s, $1 million capital loss from General Binding Corporation stock. Assuming he didn't have a lot of capital gains in the future, and at that time this was 1500, he'd have to be like Methuselah and live a hell of a long time to be able to use all those capital losses. Okay, just a closing note here. I just repaid reluctantly my dues to the American Bar Association, reluctantly for one reason. If you go to law school, become an attorney, and join the ABA, they will send you 7 or 8 emails every day, Monday through Friday. And of course, I sent it by mail, and then they email me the receipt. But the thing that's interesting here is at the bottom. You may be able to deduct up to 97.5% of your dues as a business expense on your U.S. taxes. Consult your tax advisor with any questions. 97.5% of my dues, which were $258. Why can't I deduct 100%? What's that differential represent? This is the ABA. Same thing would be true with the AICPA or the AMA. Why are the dues not 100% deductible? Anyone remember? Well, I imagine that 2.5, oh yes, Lena.
Is it because they're broken up over a number of years?
No, this was for 1 year. I imagine the 2.5% is lobbying on behalf of the profession. And remember, lobbying expenditures meant to influence legislation are not deductible. The AICPA does even more detail. They'll say, we're lobbying to make it easier, and they give reasons why they're doing that. Okay, everyone, I enjoyed everything. I went a couple minutes over here, but I'll look forward to seeing you next week on Thursday and the following week on Monday.
What's what's the most common capital losses for individuals? Is that
Sale of stock. Sale of stock without question. I mean, I could say sale of corporate bonds, but most people don't buy bonds. That's more corporate stocks.
It's mostly investment stuff.
For example, the DeVry Education Group stock would, about 4 years ago, was at $75 a share. Now it's around 30. So if you had bought at 75 and you sold now, long-term capital loss. But keep those tuition payments coming and we'll get the stock price back up. All right, thanks everyone. I always enjoy being with you. And Lena, you and I will coordinate